Good.
Hi, I'm Deborah Lucci from the Deborah Lucci team, William Raveis Realtors. And we are here today. We're a little late because we were supposed to come on with a gentleman named Mike who was from a pest control company, but he had a mouse emergency. So we called in Ryan Leahy from
Who can top
Mortgage
that?
Network. And we're going to chat about the market today. So I want to introduce you a little bit to the team members. On the top left here is Nicole Leahy. Then I have Leah Cormier and Diana Silva, Elisa O'Connell, Amanda Perlmutter, and down the bottom, the only gentleman we have is Ryan Leahy. So, Ryan, let's chat about the market. What is going on? I can feel the effects out there. How about what's going on with you?
Sure. So we've seen mortgage interest rates over the past number of months climb out from the twos that we were used to during the pandemic. And now we're seeing mortgage rates in the mid fives right now. So it's been a pretty quick trajectory up. We all knew this was going to happen. I think we just weren't sure how quickly it was going to happen. But yeah, it certainly happened pretty quick here and at the end of last year and first quarter of this year. So.
All right. So when you say, like, what are you talking about? Like, you're talking adjustable, fixed, jumbos. How are those rates going
Sure.
right now? What's going on with that?
So right now, that's talking about the conventional market, right? Which is probably 60 or 70% of the mortgages that are done out there. We're actually finding jumbo interest rates are actually better than conventional rates right now. The reason being is a lot of the jumbo investors, at least for us, are local banks, local credit unions that we sell these loans to, and they're slower to change. They don't update rates all the time. They may even just update rates once a week. So they're lagging behind with these interest rate increases, and people getting jumbo mortgages have been getting some great deals. We've seen them in the high threes or low fours in comparison to the conventional loans. As it relates to adjustable rate mortgages, they're actually making a comeback. So just a month ago, adjustable rate mortgages accounted for a very small portion of applications. That's actually doubled in the past month. So people are going back to taking a look at getting a lower rate with an adjustable rate mortgage, knowing that they may not be in the home forever, or they may have a refinance opportunity at some point in time soon. So.
Well, I've noticed we pulled some stats this Monday. We pull stats on the market every Monday. And for Andover and North Andover, Massachusetts, this is the first time I've seen the inventory actually increase since the beginning of the year. And actually, probably into the last fall.
Sure.
We could see a little bit. I noticed the houses that we put on April 5th. There was a lot of activity. There was, a huge amount of multiple offers, and we're still getting multiple offers on the houses, but I can see the activity just slowed down a little bit. And maybe instead of, like 10, 15 offers, it's going down maybe to like, 7, 4, things like that. So are you seeing, differences in applications you're getting or anything like that?
Yeah, I mean, the applications are slowing down a little bit. You still have two big segments, though, that remain in the housing market. Number one, you've got cash buyers out there, which you guys know of, and that may be, just a couple, but that also could be like an institutional investor. So they don't care where mortgage rates could, go. They could go to 50%, and they're still in the market, right? They don't care about where rates are to go. And then you have first-time home buyers. And first-time home buyers, their other option is renting. And in a market that has inflation like right now, we're seeing rents increase as rapidly as home prices. So that's not a better deal for them. So they're staying tight within this housing market. I read something from this guy, Jason Hartman, that I follow on social media, and he said, if there's 1,000 buyers that can afford a mortgage at 3%, and there's 800 buyers that can afford a mortgage at 4%, and then 600 buyers that can afford a mortgage at 5%, none of that matters if there's only 100 homes on the market. And I think that speaks volume to what's going on right now. We're still seeing appreciation because there's such a supply issue out there. So even though there's fewer buyers, there's still way more buyers than there are homes for sale. So.
Ladies, you have any questions? All right, so I'm going to ask you something, Ryan. I know I put my son, Mr. Nervous Frankie, in touch with you because it's very hard to advise your own children exactly it's easy for me to help somebody else's children, but it's very difficult when it's your own child. So I said that's it. You got to call Ryan Leahy. He'll give you the scoop, and he loved you, absolutely
Oh,
loved you.
thanks.
So if you're taking someone like my son, who's a first-time home buyer, he's done very well for himself. He does have some money in the bank. I'm going to be a grandmother again, by the way. I just found that out. So,
Oh my God.
what would you advise him? Do you think that do you think he should wait? Do you think that he should buy? Do you see the rates going up and down? Do you have? I know it's hard because you don't have a crystal
Sure.
ball.
If we look back, right, a house that was for sale at the beginning of 2021 for $500,000 now sells for $600,000, right? We've seen 20% appreciation across the country, right? In that same time, rates went from 2.875 to in the fives. So you're talking about a 30 or 40% increase in monthly payment for those borrowers instead of buying. So why wait? They already should have bought at the beginning of 2021, right? So, but we don't see appreciation going away, right? We're not going to get this reversal on prices. There's no housing blow up that everybody's waiting for. That's not going to happen. There's sensible lending. Everybody has great down payments, tremendous equity. There's no foreclosure crisis around the corner here. So I believe buying today is going to be cheaper than buying tomorrow. That's just my belief. And the folks that are so tied up with, but I'm worried about interest rates. You can never change what you pay for the house, right? But you can always change the interest rate that you pay, right, within a refinance. And in my estimation, I believe that there's going to be refinance opportunity over the next 36 months. If you're of the belief that the U.S. is going to enter a recession, which I think many of us are, every time the U.S. has entered a recession, it's dropped mortgage rates after the fact. So every single time. So there certainly could be, for these folks getting in at 5.5%, there certainly could be an opportunity for them to get 4.5% or 4% or something like that over the next couple of years and make that home even more affordable, but lock in on today's prices.
So I have a question. With the adjustable rates, can you still refinance within your time, if you do like a 7-year adjustable, can you still refinance within that 7 years?
Absolutely. You can refinance 6 months from now, 2 years from now. There's no prepayment penalties on that, meaning you can refi at any point in time. But we usually try to match up the adjustable rate mortgage with the plans that the client has. A lot of clients, rightfully so, are worried about adjustable rate mortgages, but
yeah, it seems like a riskier.
Yeah, and I think people have kind of the wrong connotation about them. They think that's what caused the subprime market that happened in the 2000s. I try to pitch longer adjustable rate mortgages, so I usually look at mortgages that are a 7-year arm or a 10-year arm, meaning they're fixed for 7 or 10 years. That's a long time. Most people don't have a mortgage for more than 7 years. So that's a long time to sell, to refinance and stuff like that. At the end of the day, if they choose to go with your traditional 30-year mortgage, that's fine too. But we want them to know that they have options, right? And like I said before, adjustable rate mortgages are coming back in vogue. People are now starting to look at them again because the rates are more attractive during the fixed period time. And it's allowing them to get back some of the buying power that they lost with rates having gone up on fixed rates.
Now, what are some of the rates for adjustable mortgages right now?
So they're in, so for instance, I'll give you an example. I just put one together where a client was going to qualify for a rate of 5.375 on a 30-year fixed loan. And we showed them a 10-1 arm that was at 4.25. So that's almost a point difference in interest rate. And they've got 120 months at that fixed interest rate. So that's a long time. this is a couple that may retire during that time. They may decide that they want to move. So there's a lot of opportunity for them to get out of that home during that time and not worry about what happens once those rates start adjusting with the market. And who knows, if my prediction here comes true and there is a rate environment that's good for refinances over the next couple of years, that's probably an opportunity that they may take to get out of the adjustable and get into a long-term fix. So.
No,
Right. To switch gears a little bit, obviously the market is still extremely competitive and we're still seeing, multiple offers. And the big thing that comes up, and I know you talk about this with everyone, is the appraisal gap. And I think a lot of buyers think that they need to, if the home underappraises by $20,000, they think that they need to come to the closing table with an additional $20,000. And I know that that isn't always the case based on what they're putting down. So how do you talk to these buyers, and what are some options for them?
So we use some software to basically show them, hey, here's if everything goes perfect. Here's if it goes 50% perfect. And this is what it looks like if everything goes wrong, right? And that way they know going into the offer process that, okay, even if everything goes wrong, we can still take care of the loan and still close on the loan. So we're good with this appraisal gap strategy, right? So I think informing the clients up front, because it is a scary thought, right? Here I am, I'm going to pay more for a house than what it's worth in this current market. And I'm scrambling around and rates are going up on me. I get all this pressure coming towards me. So informing them is first and foremost the biggest thing. But a lot of people use what's called a one-time mortgage insurance strategy. So anybody that's putting less than 20% down typically will pay a monthly mortgage insurance. And by doing one-time mortgage insurance, they can sometimes allow themselves to stick with the original down payment they planned and not have to make up that appraisal shortfall. So that usually works. If you're a 3% down buyer or a 5% down buyer, you probably don't have a ton of room for an appraisal gap strategy. But if you're over those numbers, you're likely able to do it without having to make up much money, if any, at that point. So.
And what's the typical, I mean, I guess it's different for each loan, but like what would be the typical PMI one-time payment?
Yeah, so it depends. The one-time PMI, a lot of times I see is when they're doing 20% down, right? Because they've already sold themselves on not having to pay PMI, right? And then the appraisal comes back short. So they're putting 20% down, but they may only have 15% equity, right? So how do you justify charging monthly PMI? It's difficult to do. They expected not to pay it. I mean, you could find that they may, instead of making up $20,000 in appraisal shortage, they may be able to do a one-time PMI cost of $2,000, like, and keep that extra $18,000 and remain at the exact same monthly payment as they expected. But that saves them a lot of cash, right? So, and mortgage insurance has gotten so competitive. There's a ton of companies. Mortgage insurance is pretty cheap right now in comparison to other times. So it's a very competitive market. These mortgage insurers are tripping over themselves in terms of trying to give out the lowest rates. And because of that, clients are winning. So.
Ryan, I have a question. So with like the pace of this market and how competitive it is, have you been finding yourself dealing with like a lot of last minute clients who need to get a pre-approval in order to get an offer in like in 3 days? And how does that kind of differ from the experience you have with your clients that you've been working with for a little bit longer?
Yeah, I think people, I don't see the last minute stuff as much. What I do see is clients that are planning on buying 3 months or 6 months down the road, right? That then get pre-approved, that then find a house within 48 hours. It just seems to be the way it works. Like they get that piece of paper in their hand and they're like, oh my God, this perfect house came about, and I got to go get it. So they think they're planning for the future, but then the right house just happens to pop up after pre-approval. We're also suggesting, coming from the lending side, I'm calling every listing agent as these offers go in to kind of fight for the client. Anything that we can do, maybe a bomb video too is not a bad option, because these listing agents are inundated, right? Getting offer after offer. They may not want to field my call, but they'll certainly click play in a video that I send them through email. But anything that you can do to differentiate, yourself and your client in this market is so important, right? So we're pulling out all the stops for these folks, because a lot of them have been, waiting to get into that home for quite a while now. So
what are you looking for commitment dates and closing dates around? What's a comfortable time period for you?
It's funny, 30-day commitment and 45-day close is like very comfortable. But Deb, what we're actually seeing is sellers want longer time in the home, right? We talk about use and occupancy. So, the commitments still seem to be around 30 days, but it's not uncommon for somebody to have a longer closing in this market, because the sellers don't necessarily know exactly where they're going yet, right? So they may be looking for a 60 or 90-day closing. And then in addition to that, a rent back for another 60 days. So sellers are kind of pushing off those closings instead of wanting to close in 30 days. So it's a little interesting to see that shift.
Have you seen anybody do a use and occupancy over 60 days?
Can't hear that. As a lender, the mortgage guidelines state that in order for the person buying the home to buy it as a primary residence, which gives them the lowest rates, the lowest down payment options, they have to be able to occupy the property within 60 days.
All right, now I'm going to ask you a weird question. I might be dating myself here, but I'm going to ask you a question, because these type of loans were really big at one point.
Sure.
But I've seen a couple pop up lately, maybe because I deal with a lot of downsizers. Reverse mortgages.
Sure.
Are they still available?
They are, and we're seeing them, come back around, as these prices go up, so do taxes, right? Property taxes. And you have folks that would never be able to be in their current home if it wasn't for a reverse mortgage.
So explain what that is. So let's say, for example, how much equity do you have to have in the home? Things like that.
Yeah, so let me preface this by, I've never done a reverse mortgage. They're very complicated. We actually have a specialist that works for Mortgage Network that only handles reverse mortgages. That's all she does. But basically, the gist of it is, as opposed to paying a mortgage, a traditional mortgage like we all have, right? In the case of a reverse mortgage, if they qualify based on equity position, age is another requirement, they're actually allowed to get a payment from the mortgage company. So instead of sending $2,000 to the mortgage company basically gives them a check to help them live in the home, right? And allow them to be able to afford their expenses. Now, that does eat into the equity of their property, right? So maybe the heirs of the estate may have issue to that down the road. But it's a great option for somebody of age to have, to either buy with or stay in their current home with, instead of having to leave because they're being forced out by higher taxes, higher insurance, higher grocery bills, right? We've all seen that go up. So it's a great option to have, but I would defer on the technical part of a reverse mortgage to my good colleague Lynn Coffin at Mortgage Network. So
I was just wondering if you saw more of those as the baby boomers are getting older. To me, it's something, when I've seen people have them.
Yep.
It usually hasn't been a great thing at the end. When by the time they come to me, it usually hasn't been a great thing.
True. And that's why there's an educational piece. They have to go into like a home buying counseling piece specific for reverse mortgages. And so that hopefully will put them in a position to be able to determine whether it's the right product for them. In the past, a refinance was an option because they could pull cash out of the property, right, and put it in a bank. But do you really want to be paying interest of 5.5% and having the money sit in your local savings bank making 0.25%? It's probably not the best investment vehicle for that. So as rates have gone up and refinances have decreased significantly, you may see reverse mortgages, come back a bit more. So.
Interesting.
Ryan, have you seen anybody with how quickly the rates have gone up? Have you seen anyone that has tried to put an offer on a property and then they call you, but they're pre-approval, and the last time you spoke to them, the rates were in the 2s and now they're in the 5s and they're caught off guard?
I personally haven't, but I've heard about it happening. We try to check in with our clients so they get some, we're not telling them every time the rates increase 0.1%. It's just impossible, right? But if they call us for an updated pre-approval letter, it's been a little while since we've talked to them, we reach out to them and say, hey, you know what? Mortgage rates have moved up 0.3%. We need to relook at your pre-approval. I actually did have that happen. The client understood that mortgage rates were going up, right? But they didn't want on their pre-approval a contingency to sell their current property, right? So their debt load was higher than it would be in reality if they sold their home. And because of the rate increases, we went from having to use this gentleman's base income to having to qualify him with bonus income, commission income, a car allowance that he had. When we started the loan, when rates were in the 2s, he only needed his base salary to qualify. So there's still ways to do it, but I think anybody that puts on the news or has the internet sees quite a bit that mortgage rates are moving, right? So you'd probably have to be living under a rock in order to still think rates were under the 2s. It's just common knowledge out there now. So
2 questions. Are you seeing a lot of your clients or, your colleagues' clients take a back seat and say, I need to sit this out for a bit because it's getting too overwhelming with the rates and they're feeling outbid?
The rate's not as much, but yes, you do have like that buyer fatigue, right? That you guys see your clients kind of suffer through. If it's their 10th offer and, we're going into the summertime and they're going to be traveling a little bit and they're not going to be around to go to open houses or private showings, they sometimes will say, hey, I'm going to take the next 3 months off. Let me regroup. Let me kind of get back to you after that and do that. I haven't seen it as much because of the rates. I see it more because they're just, they're beaten up a little bit, right? They've put what they've thought are winning offers in on a dozen homes and they've been rejected all 12 times. And I don't blame them. I mean, that's tough on your psyche. But the ones that stick with it and are diligent about it and keep after it are usually the ones that get the 13th offer accepted, right? It's just the way it happens. So.
Do you see anything like the rates would ever come back down to where we were? I mean, in your personal opinion and professional, I guess.
Right. So not to where we were. So the thing that you got to keep in mind is that through the pandemic, the government was buying a boatload of mortgage-backed securities. And they're willing to buy mortgages at 2.5%, 2.75%, 3%, right? But when you think about other investors that would be buying these securities, they don't want stuff at 2.75% when inflation's at 8%, right? That's a loss, right? So what you're seeing these other investors come to market and they want a 5 or 6% return, right? They're trying to keep up with inflation, right? They don't want to be lending money so cheaply. So do I think they're going to go back to 2.625 on a 30-year fix? No. But what is possible is that the government comes back into buying mortgage-backed securities after a recession to help restart the economy. And maybe they're willing to be buying them at 3.5% or 4%, and that could bring those rates down. You know, I've been doing this for 20 years. That was a very small sliver of time that rates were so low. It was free money, right?
Yeah.
And we needed it, but it was a once in a lifetime pandemic. So we needed that help to get through it. And now investors are saying, hey, I want 5.5%. 2.75% isn't a good investment for me. And that's why you're seeing mortgage rates tick up here. So
Thank you.
yeah.
I agree with you there, Ryan. I don't think these prices are coming down on houses. I don't think that they may go at the level they've been going. I can see the activity slowing a little bit. I mean, we're in May, we're in prime spring market right now, and I can see a little bit of a slowdown. But I think between people don't owe as much on their houses as they used to owe a long time ago. They just don't. So I don't think we're going to end up in some big real estate recession. I think, if and when the recession happens, I don't think it's going to be real estate driven like it was the last time, which was like a nightmare. And I think you have the baby boomers, the millennials, which are a huge group pushing, and they need housing. They're having kids, they need housing. So, and I know the rates are high to that age group, but the rates still really, even at 5, are not that high.
It's
No.
funny that you mentioned that. Like, I found myself apologizing to clients when rates climbed, right? But it's not my fault. It's just, why should I be sorry about that? That's just what's happening with rates.
I know.
It's just
Right.
it. And I felt when I started to see when I apologized for them, it actually made my client feel worse about the rates. If I had just said, hey, they're at 5% now, right? They would have taken it better. But I was like, oh my God, I'm so sorry that you missed out on that time and blah, blah.
Oh my
Literally
God.
brought them down and made them feel worse about it. So number one, I don't apologize anymore. Rates are what they are, right? And the other thing, as you mentioned with the recession, is that, in housing prices, is that people, when you think back to the 2000s, right, in that housing crash, right, the recession didn't cause the housing market to crash. It actually was the opposite. The housing market crash sent us into a recession. And that's something
Yes.
people forget, right? So it was the other way around. So just because we go into a recession doesn't mean the housing market will crash. Actually, after recessions, housing prices do pretty well. We may not see, and I'm sure, Deb, you probably think the same way, we're probably not going to see 20% appreciation again as we
Right.
did past, in a single year. That's just unsustainable, right? But could we see market appreciation of 5%? Certainly, right? So, and supply is still a challenge, and it may even become more of a challenge in my eyes, because if I've got 2.875 on a house that I haven't really outgrown, but I'd like a new house, I may decide to stay in my house and stay with that rate instead of going to that newer house and getting a rate of 5%, let's say. So that housing crunch could continue for a while until the supply fixes itself.
Very
The
good point.
contractors will do well with the additions.
Yeah, that's a really good point. I didn't even think of that. I mean, you saying that makes perfect sense.
Definitely. I mean, I think we could, for the homeowners on this session, we've all thought we love that newer house, right? But the house that fits us, right? It's got enough bedrooms, it's got enough baths. Could we, do a kitchen reno or do an addition instead and keep that wonderful rate that we have on our first mortgage and stuff? There's something psychological with holding on to that rate that may actually make people a little more wary about selling their home right now, even though they know that they can get an incredible price for their home. So
makes sense.
Well, Ryan, we're pretty much at the end of our session. We appreciate you jumping in 2 seconds and covering that's Facebook Live. We got to roll with it over here a little bit. And I can say personally, my son asked me who he should get in touch with, and I told him Ryan, and my son was extremely happy. He thought you were straightforward, told him exactly what, not what he wanted to hear, what he had to hear. And maybe Mr. Cheapy will hopefully get off the sidelines and buy a house.
Are you watching this right now on live, by the way?
I call him that all the time. He's got his first communion money, that kid.
Well, you did a good job with him, Deb. That's that's my parent goal, is to be trying to convince my girls to buy someday too. So,
but thank you so much. And Ryan, how do they get in
Thank you.
touch with you if they want to refinance, if they want to buy a home, get a pre-approval?
sure. Best way is on my cell. It's 781-307-1016. You can also visit my website, which is leahyloans.com. That's LEAHY loans.com. Thanks for having me, guys.
Thank you.
Thank you.
Thank you.